Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Scott Nelson, CEO of Occupier Services at Nasdaq-listed Colliers Global, a diversified professional services and investment management company. Scott joins me to discuss the Return to Office Occupier Survey Insights Report. Scott, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Great to be here.
All right, and give us some background on the survey and the methodology behind it.
Yeah, thanks, Jill. So the survey was really unique in that we surveyed over 200 companies and specifically their corporate real estate executives. So somebody that is guiding, leading, driving the strategy about return to office and the future of work. And so as opposed to some of the other surveys that may be out there, number one, less respondents, but number two, maybe as an example, the CEO, which may not be as focused on the details of the real estate strategy and the future of work.
Like I planned it out.
How does return to office attitudes vary around the globe?
You know, actually, one of the key findings in this survey, because we looked at that, was that it was very consistent globally. There has been more of a movement towards hybrid working before the pandemic in the U.S. more than others. But as far as the current status of how companies are returning to work, their view of hybrid in the U.S. versus other places, it was very consistent.
What's the percentage of companies that have not yet set a return to office date?
Yeah, only about 40% have not set a return to office date. And there's a nuance there too, because in that 40% would include companies that have started to communicate to their people what their vision is of the future of the office, how they would encourage people to use the office, the experiences they're trying to provide. So while they may not have not set a hard date, they've certainly been communicating in many cases about what the role is of the office going forward.
Who is and isn't embracing the hybrid workplace format and why?
You know, universally, almost everyone is moving towards hybrid at different levels. There are certainly some companies that have been more aggressive about bringing people back, notably some of the major financial Wall Street firms in New York. But that really is pretty unique to those firms. What the data is showing and what we're seeing, they're really the vast majority of companies have been moving to hybrid, and whether that's 3 days a week, whether that's fully remote, or some other variation, we're seeing that the benefits of hybrid, clients are seeing that the benefits of hybrid have really been coming true. So first and foremost, they've seen that hybrid works. There's productivity. Their people are happier. There's more of a feeling, can be more of a feeling of belonging and a cultural fit. Now that becomes a challenge when you're trying to do that with a more remote workforce. But those benefits are really shining through in many cases. Of course, there's also an added benefit in some cases of a reduction in the real estate cost for a company. As far as who's not adopting, as mentioned, those are really few and far between in our view. But the view would be, with those companies, that culturally they feel like their people need to be in the office to drive the best outcomes, to support their business plan. It could be a heavy learning and development environment. It could be a very specific type of work that it does require people to be in the office working in person together. We go back to the financial firms for an example. A trading floor is just one of many examples.
Mm-hmm. Has there been a shift in demand for short-term leases as compared to pre-pandemic? And are many companies planning to make significant changes to office space designs?
Yeah, so yes, in both cases. So first of all, there has been more of a shift to companies looking for more flexibility, and as a result, shorter term lease commitments. Now, there's some nuances there too. If a company may have been signing 7 or 10 year leases and is now signing 5 or 7 year leases, technically that's still shorter, but many people would view that as still a pretty significant commitment to a space. So those nuances do come into play. And then in addition, for example, flex space, co-working, the WeWork environments, many people have heard a lot about that in the past few years. So the two biggest flex providers, WeWork and IWG, they are seeing, as an example, WeWork just released in their quarterly results that the average term was 19 months. That sounds very short, but actually that is more flexible than what we saw pre-pandemic. Our data showed that WeWork, as an example, the average term was around 30 months. So even in that type of occupancy solution, that type of workplace solution, you're seeing more of a move towards flexibility.
What does leasing activity in top markets, including trends in suburban lease ups, and which gateway cities are recovering from the pandemic best?
Yeah, so recoveries. So first of all, this past quarter, we've seen the first positive absorption, meaning a net add of square footage, net add of square footage leased, and of course, because of the size of the markets, you look at New York or Atlanta and some of those markets, and you'll see that those were those did have the biggest square footage absorption, but so those would be some notable gateway cities. LA, another one, and then also we're seeing a pretty significant uptick in demand in suburban markets versus urban versus CBDs, and in addition, also some tertiary markets or secondary markets like a Raleigh or Austin or Nashville, markets like that.
And have RTO plans shifted in 2022 as compared to 2021, as we're kind of in the endemic phase and there's a little bit more visibility?
You know, just more of a commitment by the companies to make changes to their policy or their recommendations to their people, and then many companies, as also was tested in the survey, many companies are looking to their business unit heads, their leaders, their geographic leaders to determine what makes sense to manage their teams, to their organization. So it isn't in all cases a one size fits all top down from the CEO, as an example.
And finally, Scott, what are Class A offices and why are they predicted to be a top asset class?
So yeah, Class A offices are, the nicest, newest buildings in a market, office buildings in a market. And because of the focus on what is the experience for the people that work in the office, and how important it is that for employers that when their people do come in, they have the right environment to do their best work, to collaborate, to maybe also have flexibility to do other things besides just work in the office. And so the newer buildings, the more expensive buildings, the buildings with the most amenities and design features focused on, as an example, sustainability. This is very important to people more and more. And so the occupier clients, the tenants, are really looking for these type of quote Class A assets, as you say, and also both the investor side and the occupier side or the tenant side are very aligned on really more of a flight to quality in that area.
All right, Scott, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.